My name's Mike Bashara. I'm from Granite Consulting Group. Today, my co-presenter, unfortunately, will not be with us. Lou Fernandez from JetBlue Airlines won't be here today. Apologies, he's on business out of the country, and he could not make it back into the country today in time for the presentation. But nonetheless, I'm very confident we're going to have a good discussion today on enterprise risk management. So the presentation today is crossing the Rubicon, taking enterprise risk from theoretical to practical. And before we get into the presentation, just a word on questions and comments. I would love to not have to give a presentation today. I would much rather have a discussion and a chat about enterprise risk. So please, if anybody has any questions, comments, let's take them as we go along. I think it's much better for the questions and the comments to come up contextually rather than saving everything from until the end. We can break off at any time and have a discussion, and I think that'll be much more beneficial for everybody. So please bear with me. I'm trying to find a comfortable place to stand where I can see the screen and still talk to you. Before we get going, is everybody here a CFO? How many people are CFOs? How many are VPs of finance or controllers? Heads of internal audit? Chief risk officers? Got it. Okay. All right, so we have a pretty good mix. To begin the presentation, I couldn't think of a wiser individual than Yogi Berra to describe the difference between theory and practice. And Yogi says, in theory, there's no difference between theory and practice there is. And I think what Yogi's getting at there is that, you know, when you're drafting an accounting standard or you sit down to draft a framework like ERM, you have the best intentions. These people think through these things very deeply, and they come up with, I think, a very intellectual approach to implementing these things. But one thing that they don't have is the benefit of practical implementation. So whenever you try to practically implement something, you're going to run into hurdles and roadblocks and items that you just could not have foreseen at the time you drafted the framework and standard. So the issue with this is that I think at this point, most companies have an enterprise risk program in place. And there was a pretty sharp maturation curve over the last couple of years as companies identified what enterprise risk was. They got the templates, they got the forms, they went to their seminars. They have a base level of implementation at this point. And getting to that point was, it took some significant effort. But I think we've leveled off in the maturity of ERM, and quite frankly, we've kind of leveled off in the value that ERM brings over the past few years, because there have been a lot of misconceptions regarding implementation, practical implementation on enterprise risk management, and that's what we're here today to address. So by the end of the presentation, the three takeaways that you're going to come away with are: we're going to reconcile the theories of ERM to realities. We're going to give you some practical tips and techniques that you can take back to your company and implement. And finally, there are lots of ways to use ERM. There's lots of ways to get value out of ERM. Unfortunately, today we only have time for one, but I think it's a pretty important one. We're going to discuss at the end how you can concretely raise enterprise value with a good ERM program. Welcome to those who just joined us. I think it's helpful if we start out with identifying the theory of ERM. And this is the COSO definition on the screen. And it's basically 6 elements. So the theory of ERM, as drafted by COSO, is enterprise risk management is a process. It's not a one-time project, it's an ongoing process. It's affected by an entity's board of directors, management, and other personnel. In short, everybody in the company is involved in assessing and mitigating enterprise risk. It's applied in a strategy setting. So here we have the E in enterprise risk management. It has a lot to do with strategy. It's designed to identify potential events that may affect the entity, manage risk within risk appetite, which is a word we'll be discussing. And finally, it provides reasonable assurance regarding the achievement of entity objectives. So this is how it should all work in theory, but I think this is the reality. Is enterprise risk management is a very opaque process that not many people in the company understand or are even aware of, largely driven by the head of internal audit or a chief risk officer. And they sort of update the board and senior management when they have to, but nobody else in the company is really that involved or that invested in ERM. ERM should really go hand in hand with strategy setting. More often than not, it's pretty much divorced from the organization's strategy and objectives. I think 4 is particularly problematic. Potential events that may affect the entity. If you attend an ERM meeting, a risk committee meeting, or a management meeting where risks are being discussed, a lot of the times the discussion focuses on the most recent bad thing that happened to the company. And that's what everybody wants to talk about. Or maybe there's a prominent board member or a member of senior management that has 1 or 2 hot topics, and then the discussion focuses on that. And I think that's to the detriment of an ERM program, because what ERM is designed to do, the theory, is that it should help management attain their strategy and objectives. Risk appetite is still a term that nobody really understands all that well. And finally, achievement of entities' objectives are nearly excluded from the discussion about risk. So can I pause at this point and just see how many people have an ERM process or program at their company? Do any of these ring a bell? Oh, good. Exactly. Okay. So the format of our discussion today is we're going to run through all 6 of these theories. One by one, we're going to explain what the misinterpretation of the theory is, what the hard reality is, and what the tips and techniques are that you can take back to your company to alleviate the misinterpretation. So the first theory set out by COSO is ERM is a process. Indeed, it is a process. I think unfortunately for many people, it's a never-ending process. And what I mean by that is there's a lot of analysis paralysis. A lot of people believe if we keep studying and analyzing the risk data, sooner or later something good is bound to come of that. And, and endlessly studying something is not the same as putting forth a decent assessment, a good analysis, and actually taking the data and doing something with it that's going to help the company achieve its objectives. And I think a lot of people are locked into the endless analysis loop because ERM is not well explained to people. ERM, in the minds of many, and even board members and senior managers tend to think this way sometimes, they think risk, the ERM process, is designed to prevent bad things from happening to the company with 100% certainty. And the hard truth here is that risk assessment, by definition, is a prophecy of the future. We're trying to identify bad things that haven't happened yet. Because if they did happen, it wouldn't be a risk, it would be a loss. It would be a historical event that has already occurred. And whenever people try to predict the future, nobody's going to be right 100%. If we were right 100% of the time, or if I could or you could predict the future with 100% certainty, none of us would be sitting in this room now. We probably would be with my co-presenter in the Dominican Republic, sitting on the beach and making a gazillion dollars trading. But I think the point here is that we need to communicate to our organizations that we're looking into the future to try to identify what is going to threaten our company from attaining our objectives. We're going to make the best assessment we can, and we're going to move forward. And I think we're going to have a little extra time today, so I'm going to tell the story of the conservative engineer. At one point I worked for a defense and aerospace company, and central to defense and aerospace is management of government programs. And we would have these meetings. We would do a financial forecast on how profitable the program was going to be, and part of that financial forecast would be to sit down with the technical people, the electrical engineers, the mechanical engineers, to try to identify what threats and risks there were to the program. And there was one guy in particular that stuck out in my mind, because we would ask him what the risks were to the program, and he would say, well, I can't really tell you now, but let's meet again in 2 months because I'll know better then. And you can imagine where this is going. 2 months later we would meet again. I can't tell you now, but I'll know better in another month. And we would get to the point where the program was 95% complete, and then he would say, okay, here are all the risks. But they already happened. So, you know, it wasn't that valuable to us. So being overly conservative sometimes can hurt. You know, the takeaways is, just to reiterate one more time, facilitate the best assessment process you can and move forward from there. Affected by the management, board, and others. A lot of the times, risk is run out of the corporate office, it's divorced from the business, and there's kind of a don't call us, we'll call you type attitude with both between the business and the people running the risk program, by the way. The people running the risk program have the don't call us, we'll call you, and the people in the business are thankful for that. They have the idea that, good, because I don't want you to call me. But that's not really beneficial for anyone. The reason why we need to have many people involved in the risk program and process is because the people that are operating the business are going to understand what they're challenged with every day. They're the ones that are charged by corporate strategy, by the board of directors, by senior managers in attaining certain business objectives. And they're going to be intimately familiar with what's preventing them from attaining their business objectives, you know, most likely because their bonuses are tied to those objectives. So they're in a key position to be able to communicate what it is that the company should be worried about if the company is interested, as most rational companies are, in executing their strategy and attaining their objectives.
Risk identification may ask you to find those things which these business managers are not sensitive to.
I'm sorry, say again?
I would think you want to identify the risks that they're not aware of.
Yes, exactly. So there's a two-part process to this. And we'll get to that in a second. If I understand your question correctly, there's a bottoms-up and top-down sort of interplay here. So the bottoms up is the people in the business can communicate up the challenges that they're facing in executing the strategy.
That's what I'm addressing. You're coming
Yeah.
to that. I would think that you're attempting to address risks which they are not aware of.
Well, I think that's a point that bears discussion. If there's a risk that they're not aware of, we probably should have a discussion if that's a risk at all. Right? I mean, there are risks that can come out of the blue that nobody would have thought of, but if we don't have an ability to think of them, and if we're not aware of them, and if we can't ourselves look into the future and see them, then, you know, those are things that we're unlikely to be able to prevent with any sort of ERM process. Is that? I mean, the unknowable is by definition unknowable, no matter how many people we get in a room and how many people we interview. You know, not to parrot Don Rumsfeld here, but they're the, what does he say? The known knowns. You got it. You got it. You got it. Exactly. Why am I focusing so much on people? To continue down the thread that the question just addressed. Aren't people unreliable? Aren't people subjective? Don't people have their own biases? Won't people be blindsided because people don't know everything? All true, but the alternative sources of risk data, some people say we'll go into our accounting system, our quality system, our manufacturing system. We'll pull out lots of data. And, you know, the guy from SAP is looking at me now like I shouldn't be saying this, but historical data is good. Industry studies are good. But what they lack is an is an ability to look into the future. So anybody that's been around for the past few years, through the various economic and financial crises that we've been through, will tell you that the future doesn't always look like the past. So the past can be good. It can be a guide. We can use it to see what has happened to us in the past and assess the likelihood of it happening again in the future. But human beings have a unique ability to be able to take current data, today's data, that they just were made aware of, and develop an opinion as to how that's going to affect the company in the future. The historical stuff, as I mentioned, is a good base, but it doesn't tell the full story. We need to be able to make a prediction about what's going to happen to us in the future and try to intimate that. Applied in a strategy setting. So one of the things that people started out doing, and I think it's a good exercise, and I foreshadowed it with the gentleman's question here in the front row, is people started thinking about all of the risks that affected their company. And one of the things that they began developing as part of their risk assessment process was something called the risk universe. And the idea here was that we should or can go out, identify all of the possible things that could happen to us, all of the risks, regardless of their severity, and develop a risk universe, catalog them, record them, and then we can go through and quasi-scientifically, using scales of likelihood and impact and velocity and some other yardsticks that people use, we can assess the severity. So we identify a risk universe, we assess a severity to those risks, and then we sort them. The problem there is it's sort of a utopian idea that we're going to go out and identify all possible risks that could ever exist and could ever affect our company. But that's not the main problem, though. The first problem is it's almost impossible to do. It's utopian, as I mentioned. The second problem is, which is the more serious problem, it tends to distract people and divert people into going on a wild goose chase. So invariably, you'll be in a meeting and somebody will say, well, you know, look, there's a risk we'll forget to file that sales tax return in Fort Worth, Texas. We got to get that. We got to chase that down and assess the severity of that. For sure, filling out the sales tax return in Fort Worth, Texas is a risk, or not filling it out, I should say, is a risk. And somebody should take care of that, and somebody should worry about that. But at that point, we've lost the E in ERM. We've lost the enterprise. It's not a risk that's going to bring the company to its knees. It's not a risk that's going to disrupt the strategy. It's not a risk that's necessarily going to prevent the company. In most cases, I mean, we can all construct a scenario where the sales tax return in Texas will bring the company down. But in most cases, it's not going to be an enterprise risk. So the danger here is twofold, is embarking on an exercise where we sort of know we're not going to be completely successful, and two, getting sidetracked. The key, the tips and techniques here are to not eliminate the risk universe, the bottoms-up approach, because I don't think it's all bad. I think there's some good things that can come out of that, but we need to complement it with a top-down approach. And so this is sort of a preferred method for identifying risk within your company. So you have the risk universe, which is the bottom-up approach, right? Going out and identifying all the risks that might be out there. But it needs to be complemented by the top-down approach. And the top-down approach is, what is our corporate strategy? What are the objectives that we need to attain to execute that strategy? And what is threatening those objectives the most? And based upon those risks that are threatening the objectives the most, that helps us keep the E in ERM and helps us focus on what's going to affect our company the most. Events that may affect the entity. This one is a little more cutting edge. than some of the other theories. When identifying risk in a corporate environment and cataloging them and assessing the severity, whether using a top-down or bottoms-up approach, I think the initial tendency has been to look at risks as singular events. Look at risks as one thing that could affect the company at one point in time. So when we discuss risks in risk meetings, we're sitting down and talking about risk A, and we're talking about it as if it was the only risk in the world. But real life is not linear. It's multidimensional. Risks rarely happen one at a time and in isolation. Risks tend to happen in conjunction with one another, and they tend to interplay off of one another. There tends to be risk patterns. You know, if a policeman asks the soccer mom what caused the accident, the answer is likely to be something like, well, you know, it was raining outside, the kids were screaming in the back seat, the radio was being played too loud, I hadn't had the brakes serviced in a number of months, and I just couldn't stop in time. And that's how the accident happened. So the negative event, more often than not, is caused by a number of risks interplaying with one another and a number of risks feeding off of one another. So this is a concept of risk patterns rather than looking at risks singularly. And I have a business example of this. So if we have a hypothetical company that has only one objective for simplicity's sake, and that objective is accurate financial reporting. So all this sample company wants to do is report their financial information accurately. And they've identified a number of risks or threats to reporting their financial information accurately. One is lack of accounting experience, poor communication, excessive overtime, system implementations, and so forth. And they've assessed the severity of these risks. So the linear analysis would tell us, well, what do we need to mitigate? What do we need to worry about? Well, clearly it's lack of accounting experience and system implementations. But there are some analytical tools out there that we can use, and there's also a qualitative process that we can go through workshops and so forth that are going to allow us to look at these risks non-linearly. And lo and behold, it could turn out that the combination of aggressive marketing programs, excessive overtime, and poor communication as a risk pattern is the most serious threat to accurate financial reporting. So if we wanted to allocate our risk mitigation dollars, because all of this is subject to a cost-benefit analysis, we're all constrained by time, money, and talent. If we have to pick where we're going to channel our risk mitigation efforts, it becomes very important how we choose the risks to mitigate. And doing a risk pattern analysis can certainly help us at least make sure that we're mitigating the right risks. Out of curiosity, does anybody do a risk pattern analysis or link risks to objectives in their ERM program? Yeah? Can you tell us a little bit about it maybe? In the next session?
I'm also with SAP.
Also with SAP.
Stick around.
Stick around.
We do attempt to build strategic objectives and link and try to find patterns amongst different risks.
Good.
So,
Good. No, it's important. It's important. All right. Managing risk within risk appetite. So risk appetite is an item that's going to change. Like our hapless Red Sox fan here, his risk appetite is going to change about driving alone at night, whether he's driving down Commonwealth Avenue in Boston or driving by Yankee Stadium. He's going to have a different risk appetite depending on where he is. The misinterpretation here is that risk appetite is a set it and forget it type exercise. We identify what our risk appetite is, we mitigate our risks below that risk appetite, and we're done. Unfortunately, business is pretty dynamic. People change, processes change, systems change, competitors change, and so our risks are always changing. So we have to be careful when we set our risk appetite that we're always going back and revisiting that and reevaluating whether or not our risks are within our risk appetite or not. Some tips here. I think internal audit is it's a good group to have involved in risk mitigation. They're pretty good about not only assessing risk, but being out in the business and identifying exactly what's going on and giving an objective report back to the board and senior management. We also have to monitor risks over time to make sure that those risk levels aren't changing and the risk appetite isn't changing. Some questions we may want to ask when it comes to risk appetite would be, when is a risk mitigated? So there are risks. I guess the easiest example I could bring up is an insurable risk. So let's say there's a risk of our manufacturing facility being flooded. Well, that's more or less black and white. We can say, okay, that risk is mitigated when we buy an insurance policy to cover that. Okay, everybody can pretty much agree that it's mitigated at that point. Other risks may not be so clearly mitigated. The mitigation might be a little more qualitative. For example, in the chart that was on the screen previously, accurate financial reporting. That was threatened by lack of accounting experience. When is lack of accounting experience mitigated? How far do we go to mitigate that risk? Does everybody have to be a CPA? Does everybody have to be a CPA and MBA? Does everybody have to have a CPA, MBA, 20 years experience? It's very much a qualitative assessment at that point, and it's a judgment call, as much of life is. Linked to objectives. This particular theory is about linking the risks to objectives, and the difficulty here is we tend to divorce the risks from the objectives. We tend to look at the risks separate from the objectives, and what that leads to is us identifying some critical risks to our organization, the 30 or 40 risks that we're concerned about. We assess the severity of those risks, and then it's sort of a popularity contest, or it's a beauty pageant at that point. Everybody has their favorite risk, their scariest risk that they're most concerned about, and we have a ranking. We have the top 10, the top 15, and money, time, and talent being limited. Management has to make a call as to how far down this list are we going to go with our risk mitigation activities. Are we going to mitigate the top 10? Are we going to worry about the top 15? What is it going to be? Unfortunately, the trap you can fall into there is just because a risk is very popular, or just because a majority of people are very fearful of a particular risk, it might not have much to do with what it is the organization is trying to achieve. So going back to the E in enterprise risk management, if enterprise risk management, according to the theory, is designed to help an organization achieve its objectives, then the risks we come up with have to have something to do with our objectives, or else the ERM program won't be helping much. The key tip here is, and I put this quote in here. Maybe it's a little too cute, but we wouldn't walk into the house and say, "Honey, I forgot to get the bread from the supermarket, but hey, I didn't get into any accidents," right? Organizations exist to achieve objectives. They don't exist to just simply avoid risks. A good thing to do here to avoid all of this is to actually prioritize the objectives rather than the risks. So to embark on an exercise of prioritizing your organization's objectives is going to allow everybody to focus on what the key objectives are, what the most critical objectives are, and identify and mitigate the risks associated with those objectives, rather than figuring out what the scariest risks are and going from there. So an example of this would be a major airline. We won't mention who. They engaged in a typical risk assessment process. They identified 31 key risks, and they ranked them according to likelihood and impact and degree of control. And they did come up with a list of 31, and they divided them into high, medium, and low risks according to the color chart there. But there was no links to business strategy or objectives, and there was no relationship of risks to one another. And after analyzing their ERM process, they came up with a better system. And the better system was they linked the risks to the objectives, as you see here, objective 2, 5, 7, and 12. Each one of those is threatened by one or more risks, represented by one or more colors in the chart. And you can see that objective 12 was threatened by 3 risks. And this gave them, I think, some eye-opening insight into where to channel their efforts into mitigating their risks. So keep in mind objective 12. If we go into a deep dive, a drill down on objective 12, we'll see that this was most threatened by risk 21 and 23, along with another risk that wasn't ranked previously. And if we stop and think about that for a moment, 21 and 23 are pretty far down on the list, aren't they? If JetBlue was making a decision as to what risks they wanted to mitigate, they probably would have gone maybe 10 deep, 15 deep. It probably wouldn't have gotten down to 21 or 23. But lo and behold, objective 12 had something to do directly with their leadership. Hence, it was a very critical objective for them. So I think this exercise really helped them prioritize and really helped them focus their risk mitigation time, money, and talent on where it needed to be. Any questions about these few charts? Yes?
The enterprise, especially the large enterprise, their risk management, should it really belong in a CFO organization? Because the mitigation really is in the business unit.
Yeah, it should be. You're exactly right. I agree with you wholeheartedly, and that's a challenge that many companies have. Many companies want to put the enterprise risk management program in the financial area with the CFO, with the head of internal audit, and they want it to stay there. And the business people are happy not to be involved some of the time. And the finance people are also happy not to have the business people involved because they think, well, you know, we're finance people, we're risk experts, we can handle this. So I couldn't agree with your comment more.
When you be a risk expert, if you don't have expertise in running, for example, one of the key risks that my former company ran into was potential manufacturing plant shutdown, right?
Yeah.
That's potentially hundreds of millions of dollars.
True.
How can you mitigate that risk if you have no background in manufacturing?
You're correct. And it gets back, I think, I don't remember the myth number before, but there was a myth that we discussed a little while back about having only a certain subset of people involved in the ERM process. If you're a manufacturer and manufacturing is critical to your business, you most certainly should have manufacturing people involved in your ERM process, for sure.
So it would appear that ERM activity should be part of operations.
It has to be. It absolutely has to be. In other words, if the company doesn't exist to file SEC filings, the company doesn't exist to have good accounting books and records, the company makes money from their operations, so it's intuitive to think that most of the risks would come from operations. So, yeah, absolutely. Are we on the same wavelength here? I want to make, one second, I want to make sure
yes,
that
we are agreeing.
we agree.
This is a CFO conference, and that's why I was confused.
Well, it's not that the CFO. Yeah, go ahead.
I sort of disagree with that statement. You could have experts from manufacturing as part of the CFO's organization, even a risk management organization, like we do at SAP. We have consulting people, we have salespeople, we have product development people. We have different backgrounds in an organization that reports up to the CFO. They have the expertise in the business, 10, 15, 20 years worth of expertise. So it doesn't matter where you're functioning for, as long as you're embedded in the business and understand the
Agreed. And then what happens is mitigation. So basically, your organization will fund a lot of risk mitigation activities, correct?
Fund them?
Yeah. Or you expect
No,
them to then allocate a budget?
We will hope to find that, and we would expect the business to fund mitigation response. Sure.
Okay. Well, then this is from the last group. The interfunctional collaboration would be.
Yeah, it's not a binary choice. It's not a binary choice of CFO, you're in or you're out. Operations, you're in or you're out. It's, you know, it definitely has to be a collaborative process. Yeah.
Just a comment about that. I think as financial leaders in the organization, we actually have a viewpoint that a lot of other department heads don't have into, you know, what actually is underlying some of the risks and what can affect the revenue for our organization, what's affecting expenses. So we have this lens that, you know, someone who only deals with operations doesn't see because they don't know how it affects the bottom line. So in terms of it living in finance, I think, you know, it makes a lot of sense in that way, but it absolutely takes collaboration between all departments.
Yeah.
Because, and I can tell my operations team, you know, people are managing all the purchasing on their Amex cards, right? Please go, if they own purchasing, I can say, you know, you have to work with them on that. They don't know that, you know, that's a high risk for our organization because, you know, people aren't getting expenses first. They're thinking, oh, it's easier for them to purchase that way, so go for it. And that's something that I have to then go back and retrain and educate and, you know, help them put processes in place to mitigate that risk for our organization. So it makes sense that, you know, finance sees it from the top, but it absolutely takes everyone's
For sure.
collaboration and making sure it works for everyone.
Sure. I appreciate those. And I'd like to piggyback and say, you know, there are enterprise risks in finance. Access to capital is pretty darn important to some companies. So there's enterprise risks all over the place. Yes.
And I would even go a step beyond that. I'm with a public company, and the finance group is bringing that information to the audit committee, who has the responsibility, as designated by the board of directors, to be overseeing the enterprise risk management process. So, I mean, we're actively engaged. The audit committee is engaged. The board is engaged, and so it really is, I think, a very important finance function and does involve a lot of different departments. So.
Sure. Sure. Absolutely.
So one thing I want to add
Yeah.
to that is,
Sure.
it depends on what the business is like. So I work for a bank.
Okay.
And we are not even legally allowed to have risk management inside finance. We have the independent risk management function.
Okay.
Of course, we work very closely with finance, but enterprise risk management, along with counterparty and credit and everything, lies in an independent level organization. So,
The only thing I would add to that, though, is as a CFO and having to sign a certification every quarter, I mean, you know, it is very important to me that I be involved and see some of that. So I would just.
Oh, sure.
I think it boils down to collaboration. Doesn't matter where you decide, it requires expertise from all different areas.
It does. It does, and it depends on the type of risk that comes up for discussion. You know, it's important for finance to be involved because they do have that perspective. But you know, you can't exclude operations. You can't exclude even compliance. In some cases, if you're in a heavily regulated industry like banking, you know, a compliance risk could definitely be an enterprise risk. All right. We came alive in the last 5 minutes. Okay. So what do we do with ERM? Once we have this great enterprise risk management process, there's probably many things, many valuable things one could do with ERM data. But I decided to pick one in particular to highlight it because I think it's not well understood. Perhaps it's something that I've seen a few people doing, and I'd like to offer it for your your discussion and hopefully your benefit. And it has to do with enhancing enterprise value, directly enhancing enterprise value. And what do I mean by that? Well, Our companies are constantly being evaluated by outsiders, investors, lenders, rating agencies, acquisition partners. Everybody has their models, and everybody's valuing our company at one point or another. And as a CFO or as a senior finance person, one of the things we're charged with is telling our story to outsiders, telling our story to Wall Street, telling our story to the lenders, to the rating agencies, and if there's an acquisition partner that shows up, you know, making that story as well. And ERM affords us an opportunity to directly raise the enterprise value in the eyes of those outsiders if we understand how those outsiders are assigning value to our company. So this is going to take me a few slides to build up here. It's a walk down corporate finance memory lane. So, you know, bear with me for a second. We'll get to the punchline as quick as we can. So the first thing is, how do outsiders value us? There's three main valuation approaches: the asset approach, market approach, and the income approach. We're going to focus on the income approach. Why? Because it's the one used most often by Wall Street, by lenders. It's the most prevalent one. And the income approach, in a nutshell, is taking a stream of future benefits that your company will produce, cash flows or earnings, and discounting them back to the present to arrive at a value. And the key component of the income approach, the key component in calculating enterprise value is, what should that discount rate be? And that discount rate is also known as the rate of return that an investor would require. And the rate of return and the value of the enterprise are inversely related. So if an investor would only require 5% to invest in your company, your enterprise value is high. And why is that? Well, because he requires a low rate of return, because you're a blue chip company, you're kind of a sure thing, you have a strong record of paying dividends, you know, the stock is appreciated, you know, steadily over the past couple years. So, you know, he's going to accept a low rate of return, and he's going to value your company highly. On the other hand, if you're investing in an internet startup, you know, the investor may say, well, listen, they're not profitable, the company hasn't been around except for a few months, I need a 30% rate of return. So with a high rate of return, you have a very low valuation, and the valuation is low because it's a risky investment. So the key concept is rate of return and valuation are inversely related. Now here's the big ugly formulas and the scary formulas, but how do you calculate rate of return, or how do you calculate the discount rate? There's two basic ways: capital asset pricing model and build-up method, but they all have the same components. The thought process is, from an investor's point of view, what's the risk-free rate of return in the marketplace? What rate of return can I get on the 20-year treasury that's, you know, not that it's risk-free these days, but more or less risk-free? On top of that, I want a premium. I'm going to add on a couple points to the rate of return because I'm investing in something scary like a stock, right? And on top of that, well, maybe the company that I'm investing in isn't so big. Maybe it's a smaller company. So I want a little extra on my rate of return for a size premium. And here's the punchline, folks. The last element of the discount rate is company-specific risks. The analyst will add on a factor for risks specific to a particular company. And the key point here is, how does he identify your company's specific risks? And let's go right to the bottom, to the red text. There's no objective source for company-specific risk. It's a total judgment call on the part of the analyst. The analyst, if he thinks you're riskier than other companies, is going to add on a few points. Another important item to note is the company-specific risk premium can be negative. If he thinks you're a well-run company that has a good handle on your risks, he can lower the discount rate by a few points too. So it's really important to be able to explain to an analyst how we're managing our risks. And what is an analyst going to consider when looking at company-specific risk premium? Well, he's going to take a look at the strength of management. He's going to look at the the threat of competition, litigation, customer concentration, supplier bargaining power, the quality of your company's strategy, and geez, this sounds an awful lot like ERM, doesn't it? So in a nutshell, he's using an evaluation of how well you're managing your risks to come up with that company premium. So how do we tell the ERM story to outsiders? Well, here's some do's and don'ts. Explain the present, but focus on the future. We want to make sure that we communicate that we have a good strategy. These are our objectives. These are the risks that we see threatening our objectives. And this is what we're doing to mitigate those risks that threaten our objectives. Also ensure on the bottom there that they understand that ERM it's not just a one-time thing that we do, whenever we feel like it. It's an ongoing management tool, an ongoing process. The don'ts, lengthy explanations of history, I think as a general rule, tend to sound like excuses sometimes. So we want to avoid saying, well, let me tell you why we are where we are today and go through all the bad things that happened and how none of those things were our fault. Another important point is we've just gone through and explained, I think very clearly, that enterprise or the company-specific risk premium, it's an absolute judgment call. And I think some people fall into a trap when they present their risk program as overly scientific or precise. Risk A is 3.43256. Well, people understand that risk is looking into the future, that evaluating risk is subjective. So presenting it as overly scientific may actually undermine it a little bit. And of course, you always want to avoid jargon. Likelihood, impact, velocity, risk appetite. Those are very specific terms that may not resonate very well with an outsider. Here's the recap. So the theories versus realities. We want to build a good process, source the risk from the business. Risks to the enterprise are what we want to focus on. Evaluate risks and risk patterns, continually reevaluate our appetite setting, and mitigate risks in the context of objectives. And lastly, enterprise value and rate of return are inversely related, and we want to make sure that people, outsiders especially, know that our risks are well managed so we can get a high valuation. And that's it.